Thanks for watching Income Method Basics from High Dividend Opportunities. My name is Will Barton and I am the lead analyst at HDO. This series has been curated to help you understand investing concepts and our methodology. In this episode, we're talking about property REITs, what they are, how they generate income, and why two REITs in the same category can behave very differently. Let's start with the basics. A property REIT, also called an equity REIT, is a company that owns physical real estate. It makes money by leasing that real estate to tenants and collecting rent. This is different from a mortgage REIT, which owns loans, not properties. Property REITs fall into two broad buckets, diversified and specialized. Diversified REITs spread ownership across many property types and hundreds or thousands of tenants. Realty Income and NNN REIT are classic examples. Because no single tenant or sector drives results, these REITs tend to produce stable, predictable cash flow, and many have long records of consecutive dividend increases. Specialty REITs focus on one type of property, healthcare offices, experiential entertainment, data centers, or another niche. EPR Properties is a good example. It owns theaters, amusement parks, ski resorts, and other experiential venues. Specialty REITs carry more concentration risk, but when the thesis plays out, they can offer attractive income and total return. One concept that matters for both types is the lease structure. Triple net leases, or NNN leases, place nearly all property-level expenses on the tenant: taxes, insurance, utilities, and maintenance. The landlord collects rent and stays hands-off. This structure is highly scalable and it makes income more predictable for the REIT. At the other extreme, a gross lease means the landlord absorbs all those expenses and charges higher rent to compensate. Most publicly traded REITs today use triple net or double net structures. Knowing what drives income also matters. For diversified REITs, it is rent from a broad base of tenants on long-term leases. For specialty REITs, the health of the tenants industry is critical, because the real estate is often inseparable from the business. A theater company without theaters has nothing. The same is true of a ski resort or a water park. Interest rates also play a role. REITs borrow to acquire properties, so changes in the cost of debt affect their growth and their valuations. This is why property REITs often move with interest rate expectations. For income investors, property REITs can deliver consistent dividends backed by real assets and long-term leases. The key is understanding what kind of REIT you own and what drives its income. To put this concept to work and to unlock our full portfolio, consider subscribing to High Dividend Opportunities on Seeking Alpha.